Welcome to Power Charting. I'm your host, Bruce Frazier, and thank you for being here. We're going to have, I think, a most important discussion today about the business cycle and the rotation of sectors through the business cycle, which we now understand are in a logical, sequential march as they go from the beginning of a cycle to the end of a cycle and then into the next. And if we can understand the logic of this sequence of events that occurs over time, this gives us a very powerful tool to be able to understand and be able to execute our strategies in the financial markets. Now, the reason that I know that is because I have had this remarkable mentor, as many of us have, and that is the amazing Martin Pring. And Martin has done some of the most important landmark work on business cycles, how to capture the knowledge and the understanding of how business cycles ebb and flow over time, and has used the technical analysis tools in his toolkit, many of which he created himself, to be able to capture the essence of this knowledge. And we have with us today Martin Pring. And Martin, welcome to Power Charting.
Thank you very much, Bruce.
So I'm very excited about our topic, using the KST as a GPS for sector rotation, a most important idea. And KST is one of Martin's unique indicators that he's created to help to capture the essence of this information. And so, Martin, in the time that we have, let's get started, because we're going to do some heavy lifting in this half hour that we have.
Well, not too heavy, I hope, Bruce.
Well,
you may not recall it, but I had my second TV interview 35 years ago in May. And you know who interviewed me?
Who?
It was you.
No.
Yes. But we digress. I think we better get started, Bruce. We don't have a tremendous amount of time here.
We have a lot to do.
So this diagram I'm putting up on the screen now is explaining the business cycle and its growth path. So when the economy isn't growing, it's working along this blue line here, which is the equilibrium point. So when it's below the equilibrium point, it's declining at a faster and faster rate until it makes its maximum downside potential just here, and then it begins to recover. But it's only when it gets above the blue line again that we get into a growth path, a positive path. Now, why is this important? Well, it's important because the economy is not one set thing. It's really a set series of chronological sequences. You've all heard of the leading, lagging, and coincident indicators. They're called that for a reason, because there's some indicators that move ahead of the economy and some indicators that move behind the economy. The stock market is the same thing. You think of basically the S&P as being a coincident indicator of the economy, and then there are various sectors that lead and lag the economy, which we'll get into later, and kind of get an idea of how we can recognize where we are in the cycle by looking at the actual positions of these particular industry groups and sectors. So the other thing is that the peaks and troughs of the three markets, bonds, stocks, and commodities, happily all fall into this business cycle sequence. So it begins as we move into a recession, with bond prices bottoming out as interest rates peak. Typically, you have to be in the recession because the Fed is usually, and it controls obviously the supply of credit, which influences the price of credit, which is interest rates. They tend to act with a little bit of a lag because they're typically battling the inflation problem, which caused them to tighten rates. And as we come into a recession, so they begin to slowly realize that the battle they should be fighting is unemployment, not inflation. So typically bond prices are going to bottom as we get into a recession. Sometimes it doesn't happen exactly that way, because the stuff I'm talking about this afternoon is not necessarily cast in stone. It happens most of the time, but there are always exceptions. Nothing in this business is perfect.
So
So anyway, bonds
these are effectively tendencies that we see where we can get some things that lead in one cycle a little more than they would in the next cycle, but the tendencies tend to hold true, and sometimes the lead lag relationships can change.
Yeah, that's absolutely correct. So typically what happens is that bonds will bottom and interest rates will peak as we're coming into the recession, early part of the recession. And the stock market loves falling interest rates because that when liquidity comes in the system and interest rates fall, what does that mean? That means that down the road there's going to be a recovery. So the stock market, after a certain amount of decline in interest rates, theoretically bottoms at the absolute worst part of the cycle, when the downward momentum is at its maximum, as we see here. Because the stock players are not standing still, they're anticipating the next recovery, which is going to be taking place as we cross that blue line. So as you know, the stock market moves ahead of the economy, and that's why stocks typically will bottom when the news is blackest, when the downside momentum in the economy. And when we talk about the economy in this sense, we're talking about the coincident indicators, the rate of change of the coincident indicators.
So this is like the maximum acceleration downward of the business cycle is the time at which the stock market becomes it comes into the area of its lows.
Yeah, whatever.
It's a cruel truth about the way that financial markets and the stock market work.
That's right. It's when the news is blackest, and that's the time to be buying stocks, not when the news is obviously good. So now we have two markets going up. We have stocks and bonds going up. And then at some point, the demand-supply balance of commodities comes into balance more for the demand side. So the price of commodities bottoms out as we enter into recession. Sometimes it's going to happen during a recession, though, Bruce. And that's because with the previous cycle may have seen a tremendous amount of speculation in commodities. So we get as commodities come down in their bear market, we get a margin call. And that pushes commodities to their lowest point during the recession rather than in the recovery. But typically what's going to happen is it's going to bounce around and not really get a sustained advance until we get into the recovery phase. So at that point, we have everything going up, bonds, stocks, and commodities. And as with all good parties, they almost come to an end. And as the economy improves, so the Fed begins to anticipate that there could be some trouble with some overheating, and they begin to raise interest rates. And when they raise interest rates, of course, that means that bond prices peak out. So now we have...
Not unlike what Fed Chairman Powell was doing in 2018, where he was tightening up, reducing the balance sheet and tightening up interest rates, right, raising rates.
Correct. And so at this point here, we've got two markets going up, stocks and commodities, and bonds peaking. So stocks don't immediately peak because while they don't like rising interest rates, the rates at this point in the cycle are rising for a positive reason. That's because the economy is strong, but not overheated. And at that point, profits are going up at a faster pace than interest rates. So the stock market continues to move on up. And typically you'll see a top in the stock market at a point of maximum upside growth potential and momentum. And then from that point onwards, the stocks, just as they looked at the next recovery here, are now looking at the next slowdown or the next recession. Stocks peak out. And finally in the cycle, we find that, commodities peak out as well. But there's one thing that's important from a point of view of our exercise here this afternoon, Bruce, and that is that at different points in the cycle, we have what you might call different seasons. You know, if you're a farmer, you're going to be, generally speaking, planting seeds in the spring and harvesting in the summer or the fall, because the conditions are right for that. Well, at the same time, on this business cycle stuff, there's a good period for investing in bonds and interest-sensitive stocks such as utilities and REITs and defensive issues such as consumer staples and so on. And they tend to improve or bottom out in their relative action at around the low point in the cycle. And then there's another point in the cycle where the commodities are doing well, bonds peak. So these early cycle leaders start to deteriorate at the point when interest rates start to move up. And that's taken over by the resource-based areas and the basic industries. And we'll kind of look at that a little bit later on. So let's just take a look at the trends in the stock market, how it's made up. This is a bell curve indicating the primary trend of the stock market, the one that revolves around the business cycle, and that typically lasts from 9 months to 2 years, and sometimes longer. We've seen a much longer bull market since 2009, but that bull market has been interrupted by two slowdowns on the way, not recessions, but slowdowns where the growth path came down towards zero and then started to turn up. So that's still, and those have been separated by around 41 months. So it's still been operative, even though we haven't had an actual recession. So the primary trend doesn't go straight up and straight down. It also is interrupted, and that is by intermediate trends, which are determined by actual believable events that take place. So, for example, just here, this may be the stock market. This diagram, by the way, is a theoretical diagram for any financial market. But this maybe we're looking at stocks, and if that's the case, then maybe at this point here, the Fed decides to raise interest rates, as we were talking before, and that causes the people to say, well, the growth path is going to slow down like we saw last year, and we better sell stocks in anticipation of the next recession because they're raising rates. But then they realize that the rates are rising because of an improving economy, and that's good, not too overheated, and then it moves on up. Somehow, there's always a believable reason why we get these intermediate rallies taking place, and they typically last from 6 weeks to 9 months. And finally, you have a more random event, which traders will be more interested in, and that's the short term, which operates from 2 to 6 weeks. So the idea here is that when I developed the KST indicator, which I'll get to later, I devised it for 3 different trends: short-term, intermediate, and long-term trends, so that we could follow each of these individual trends with their own time cycles and their own parameters. We, in this presentation, are going to be concentrating on the primary trend, which lasts from 9 months to 2 years. So here's the primary trend. We strip away the short term and the intermediate. We're left with the primary trend. And a good tracking device for the primary trend is long-term smooth momentum. And that could be the KST, could be a stochastic, it could be an MACD. What we're trying to do is understand what the cyclic rhythm is in the cycle that we're in the market that we're following, and in the cycle we're following. Because you can apply this stuff to bonds, stocks, commodities, sectors, individual stocks, and so forth. So we're trying to get at the underlying cyclic rhythm. So here's a diagram or a chart, actual chart now. We've got the copper price on the top. It's a monthly chart, and we've got 3 measures of smooth long-term momentum: the KST, the stochastic, the MACD. I personally like the KST, and I'll explain why in the next few slides. But I wanted to point out to you that if you can't plot the KST, which you can, of course, on stock charts, the stochastic, using the parameter 24 months by 15 months by 10 months, will get you pretty well most of the way there. And the same thing with the MACD, as long as you use simple moving averages rather than exponential. If you use exponential on the monthly charts, you tend to get a lot of extra whipsaws that you won't get if you use the simple moving average. So the KST, which stands for no sure thing, because it works most of the time, but K and OW know it's not a sure thing, is the one that I use, and I'll explain a couple of reasons why I use that over these other 2 indicators.
And one of the features of all of these is that it actually detrends the data, which it rotates around a central cycle or a 0 point, is that it gives us a better look at the cyclicality.
Yeah, absolutely. And as I said, these indicators more or less act in a similar way. I mean, here's the major lows with the 2 arrows. There's the major highs, and they kind of intersect in a similar way. It's just that with the KST, you tend to get fewer whipsaws. It's by no means a perfect indicator. That's why we call it the KST. It's not a sure thing. But I think it gives a smoother and yet a more timely signal of important reversals. And remember, we've got KSTs not just for the long-term trend, we have for the intermediate and the short-term as well. So if you want to learn more about the KST on stock charts, it's as simple as 1, 2, 3. First thing you do is click on Chart School at the top of the main legend there. Then you put in the letters KST as number 2 in the search. And when you do the search from this page, you get a full explanation of the KST along with all the parameters for its various components. The short term, the intermediate, the long term, explains exactly how the KST works and so forth. Goes into a lot more detail than I can today.
So in the time that we have about 13 minutes left, because I want to make sure you have enough time to go through the sequences. But go ahead with this KST example.
Yeah, I was just going to point out how you can plot and put in the parameters for the KST in stock charts. First thing you do, I'm obviously, if you don't know what they are, you can't put them in at this point here, but you can put any. You can put this in from the way I'm explaining it now, which is not very well, is it? Anyway.
Well, they can go to the article and they can see the parameters for monthly.
Yeah, exactly.
They can plug those in. They see the parameters for weekly and plug those in. And so your article is pretty good at explaining exactly what to do to replicate these charts.
Yeah, thanks, Bruce. Yeah. Well, here you can see the parameters used for the monthly, but it doesn't give you all the parameters there. So if you click on that little box there with all the numbers in, it brings up the right numbers. So if you take those numbers down, those are the numbers for the long-term KST, which are also in the article as well. So here is the KST itself plotted against the S&P composite. And it's not a perfect indicator by any means, because we're assuming in its calculation that we have a normal business cycle taking place. But if the business cycle lasts for longer than, I'm sorry, I should have also explained before I get to this, how once you've got the KST plotted, you don't have to keep putting in all those parameters, which is a real time consumer. What you can do is save it as a style sheet. So if you have a setup that you like you have here, you can click on Add New, which is just below the legend here, and then that will set up this little box here where you can give the chart style a new name. And you can even put it on one of these buttons up here, and then you can bring it up at any time you want to. So that's just an explanation how you might want to incorporate it into stock charts. You can also bring it into a chart list as well. So let me just go through very quickly one of the principles of the KST. When you plot any individual momentum indicator, you're really just plotting one time span. But price at any one particular point is determined by the interaction of a lot of different time cycles. So it would be good to capture some of those time cycles in your indicator. And that's what the KST tries to do. So let me just give you a quick rundown here of this point here, which is those points marked by the green arrows represent the buying opportunities in this theoretical diagram. And these are two different cycles. So what happens at the major buying points? You've had a good rally, and what happens is that rally is enabled by the fact that those two cycles are in up phase. So that gives us a green shaded. So where you can see the green shading take place, that's where the two cycles are in an uptrend. And then we can see a couple of other examples along here with these great buying opportunities, and each time, the two cycles in an uptrend. By the same token, we can look at a major peak just there. What are these two cycles doing? They're in gear on the downside. And we can keep going through with that all the way through the chart. And then we're left with some trading ranges. Well, guess what happens in a trading range? What's happening is we're getting the cycles moving in the opposite direction, which causes us to have a bit of a trading range. So I've colored those in gray as a gray area. So let's take a quick look at how this might work out in practice. Here's the copper price up in the top window. Underneath is a 9-month rate of change, a 12-month rate of change, and an 18-month rate of change. And we're going to look at this point just here, which is an important inflection, low point inflection, just before this big rally took place. So what happens during the rally? All three momentum indicators are in an up phase. And we get a peak with the down move, and what happens during the down move, which is reasonably severe. all three momentum indicators are moving down. Although you notice that the 18-month rate of change is still in a positive position above the 0 level. Then we get another important low, and what happens at this low is we get a fairly anemic, a rally, but a fairly anemic rally. And the reason is one indicator is going up, one momentum cycle is going up, and the cycles that these two time periods are reflecting are going down. And then we get a little bit more confusion here, but we get another small rally, and we're getting a conflict with a sideways movement, a down movement, and an up movement. And then finally, the big decline taking place, and everything is moving down at the same time. So with the KST, what we do is we combine 4 different rates of change and smooth them into one indicator to try and capture all of these as many time cycles as we can. Obviously, we like to have 100 or 200 of these time spans included, but then it gets a little bit too complicated. So here is the chart which I was referring to earlier, and this is the one where we have an example of the strengths and weaknesses of the KST. First, we see the KST or the primary trend lasting for 5 years, which is longer than the usual 9 months to 2 years that we saw in our theoretical diagram. And what happened there, of course, is that the KST peaked ahead of time, way ahead of time, to be too useful. So that's one of the drawbacks of the KST or any smooth long-term momentum. If the cycle is expanded above where it normally would do, that particular indicator is going to give you a premature sell signal. That's why you need to watch what happens to trend lines and long-term moving averages to make sure that the price agrees. The other advantage is disadvantage occurs at the other end of the spectrum. When we have a small decline and we don't have enough time for this smooth momentum indicator to start to turn up or to turn down ahead. And so it tends to actually confirm what's happened rather than forecast what's happened. So these are 2 areas where the KST runs into some problems. The other thing is it doesn't necessarily turn from below 0. It can turn from above 0. It gives us a high risk signal, but it's still a bullish signal nevertheless, and still should be respected. So what we're going to do now is take our knowledge of the business cycle and the fact that there are various leading and lagging groups during the cycle, and each one does different things at different points in the cycle. And we're going to use that to kind of take a look at a tapestry of where the KST would be for multiple sectors at key turning points in the market. So the first key turning point we're going to look at is this low in 2003. Okay, so this curve here is the long-term KST, or symbolic of the long-term KST. And we're going to be putting in red arrows, which indicate early cycle leaders, where what their position was on this KST bell curve at the 2003 low. So these are the early cycle leaders, things like REITs and utilities and so forth, in red. And in green, we're going to see the late cycle leaders, those resource-based areas, technology, stuff that tends to do better at the tail end of the cycle. I say 10 because there's no hard and fast rule about any of this, but you can see if certain groups are behaving in a certain way, you can sort of interpret much better where we are in the cycle. So in the bottom in 2000, remember looking at 2003, in March 2003, this is approximately where the S&P was. It was in a great position to rally because anywhere down here is good from the point of view of rallying. Anywhere up here or up here in the KST is obviously much more indicative of a high risk, much more vulnerable situation. So here you can see the early leaders, and they're all positioned basically in a position where they can rally, led by the home builders, which tend to be very interest sensitive and make a very nice leading industry sector, or a leading sector. So they're all these early leading stocks or sectors were in a good position to signal a rally, which is what you want. But what about the late cycle? Late cycle in green.
Martin, we have about 3 minutes left. I just want you to know.
2 minutes. Okay. So
Three.
These are in a strong position to rally as well. And now, in the second time, we're going to look at the peak in 2007. Use the same exercise here with the early and late cycle leaders. And we see that we're in a totally different position. There's the S&P up there. There's the early cycle leaders all coming down, indicating downward pressure on the market. And then there's the late cycle leaders, which are also basically all coming down, or if they're not coming down, they're in the process of peaking out, like the materials and the metals over here. So that gives you a kind of an idea of what the pattern would look like at a market peak. And then finally, in February 2019, here's the same exercise. We've got bonds looking up in a positive mode. The S&P is sort of halfway down, and maybe it could do one of those high risk signals where it would turn up like that. But right now it's coming down, and also we're seeing industrial commodities are well advanced into their bear market as well. So once again, we're going to put up the early and late cycle leaders, and here's the electricity, the electric utilities, REITs, home builders, transports, and so forth. Some of them in a good position to signal a rally, and some of them are in the process of still declining.
This is encouraging. Sorry.
What's that?
Oh, this is encouraging because it shows that these are coming down into their lows potentially. We don't know exactly when the low will take place, but that you already have some of the early defensive leaders turning up. And so it might be that in the not too distant future, these different sectors could be ready to start to turn into a new uptrend.
Yeah, I mean, it could be that there's going to be some backing and filling, some rallies and reactions where this stuff has a chance to get into a more positive position. That's exactly right. Or some of it could easily turn up from this high level here.
And our job is not to get ahead of this, but to be patient and wait for the signals to set up, which is always the key point that you make.
That's right. And in the meantime, you've got these groups here, which are looking pretty good, including gold shares too.
And these are tend to be early leaders.
Yeah.
So it looks as though there's a new cycle that might be in our future. We don't know exactly when, but.
Yeah, absolutely. So let me just wrap up here. There's a chronological sequence between the peaks and troughs of bond stocks and commodities as they revolve around a business cycle. And this progression can be tracked with long-term smooth momentum. KST is a useful indicator because it's constructed from several different time spans and therefore reflects several different time cycles. Tracking the long-term KST for multiple sectors offers a useful roadmap for the prevailing stage of the cycle. So that completes what I have to say, Bruce.
Oh, that's wonderful. Martin, thank you so much for your time today. But let's go on to tell people how they can find out more. The Intermarket Review is Martin's incredible newsletter, which he's been publishing for 40 years. It's available at Pring.com and is essential reading in my view. And then also you can go to pringturner.com and sign up for their email newsletter list, which you go to pringturner.com, go to the blogs and put in your email. And also that's a great place to contact Martin and the Pring Turner team. And then finally, I'd like to recommend Martin's incredible landmark book, Technical Analysis Explained, which is in my opinion, is a must read. When I was teaching graduate school for a number of years, this technical analysis book was my textbook, and I had every student read every page of it, and it's a remarkable teaching aid. It's a great way to learn technical analysis. So Martin, thank you so much for your time today, and I hope that we can come back, follow up on these indicators, and do more on this subject.
Yeah, thank you very much, Bruce.
Thank you, Martin.